Hey guys, Freaky Finance here. Today we're going to look at Google and then Visa. They recorded last night. Excited for IMAX tonight. We got a couple more. Always the thralls of earnings season I like. Got Meta and Roku, which will be interesting. Etsy too is going to get interesting. It's getting pretty cheap. Well, relative to what it has been anyway. Alright. Let's dig into it. But yeah, just want to disclose before we jump into it. I do own Google. I do own it for a while. I own it on the Canadian side. But yeah, let's jump into her. So Google, we brought this up in the video when we did Google a while back. That the balance sheet's immaculate, and you can see that here. Now you can see basically 93 billion in CCE. Pretty powerful. I mean, they have started to use the cash for buybacks, which I think has helped over time. Google still trades relatively cheaper relative to the other big mega companies, which is interesting. And it gives off just a ton of cash flow. See that here in the cash flow statement, just 73 billion on the 9 months. And if they add back the share-based comp, 16 billion, and depreciation of 11, you're getting quite a bit in terms of cash flow. You're going to notice depreciation's actually shot up quite a bit on the balance sheet. You see that really right here on the PPE side. It's pretty exciting how much they've spent on cloud. We saw this at Meta, we saw this at Amazon, probably will see that when they report this week as well. Just the acceleration in capex in 2024, which has been to the benefit of NVIDIA, as we know. So that's interesting to see. Now, Google did say something interesting that they're gonna spend more again in capex in 25. We'll go into that quote as well on this video. But yeah, they said they're going to spend more again in 2025, but it won't be the same step change increase. So in terms of rate of change, it's still going up, but it's not going up as much. So that's interesting too, because we just saw a big capex spike, and that was the big uncertainty for this year, is how the market would treat it. So let's go into this. So I mean, in terms of the business fundamentals, it's just scale across every line. We'll break it down on the next slide, but what you can see here is just a lot of cash flow, pretty much steady improvement year over year across every line item. And EPS is also shooting up, partially also because of the buybacks that have accelerated the EPS growth. One of the things I always look at on the quarterly is just the revenue backlog. What I like to see is this still increasing. So, and it is. So even though Google Cloud is growing so well, it's still capped by a backlog, and the backlog used to be at 50 billion, 60 billion, now it's at 83 billion, or 86.8 billion rather. So a lot of backlog on the cloud side, and that's what I like to see, because that means it's still getting better, which means they're not. What I don't want to see is them chase the capex, and then all of a sudden they start chewing down that backlog really quickly. So I want to see them moderate the capex in relation to the backlog. Right now, the backlog is actually accelerated while they're starting to pull back capex. So that's really good for me, for a cloud, in terms of margins. And we're also seeing the margins start to scale. They're not yet at Amazon level scale. They're not at Amazon level margins on the cloud side, the AWS side, but they're getting there, and I think they are going to get there. So that's just my opinion. What else is there? I mean, we'll talk about the segments, I think, on a couple. So what I always look at in terms of costs, I look at costs first, then I look at revenue. I'm kind of weird that way. I like to see scale. Now, one of the reasons we're seeing scale, and to be fair, Google's scale monster, and the TAC is total acquisition cost, so traffic acquisition cost rather. And it's just, you're seeing scale here, and part of this is because the network revenue is decelerated, whereas search revenue continues to grow, and search revenue is actually the higher margin product in terms of a COGS breakdown for terms of sales mix. So we're seeing margins expand on the COGS side still for Google, which is pretty crazy given Google's size already. But we're also seeing it in terms of R&D. This is a funny number just to bring up. Just imagine you're 9 months in, $36 billion. You're pretty much spending, $1 billion a week in R&D. And like the media was like, oh, Google's behind. I'm like, they're spending $1 billion a week in R&D. I don't know. So that was the narrative when we bought the stock right there. Like, oh, AI is coming in to kill it. And I'm like, well, Google's going to be one of the beneficiaries of AI. So anyway, it's just something to bring in mind. That has also scaling, even though they're spending $1 billion a week, we're still seeing scale, which is impressive. And then you have the scale on the COGS, or the sales and marketing. You're seeing scale, even though it's going up, it's going less than revenues going up. G&A G&A is actually, this is a lot of scale right here, and a part of that is just less legal fees, especially in the quarter. So last year they had more legal fees, this year they don't. So that's kind of noisy, but we are still technically seeing scale there over time, and we should see scale on the fixed side for Google, and we saw that for the whole life of Google. We'll show up just a trend in the bit, but it's just pretty interesting. This is the PPE. I just like to see where it was going. You can see that it is all going. Well, not all. A lot of it's going to infrastructure technology assets or construction and process. So again, a lot of capex into the cloud side. That's what we're seeing here, and that's why, because I did see it shoot up $30 billion in a single year on the PPE side for something that's traditionally been a capex like business model. But we know cloud is actually capex, relatively intensive. I also think what's happened in the entire space, and to NVIDIA's benefit as well, is, and we saw this at Intel first. They decided to increase the server depreciation length for the useful life. I think from like 4 years to 5 years. I know it doesn't sound like a big deal, but that's like an extra year that you can spread the cost out. And I think that also made the cost benefit analysis for all these companies to basically say, yeah, let's do it. It just makes that easier. So break evens are easier. In terms of reported EPS growth, when you can depreciate something over a long amount of time, you're going to basically increase the EPS growth. And anyway, once Intel did it, Google did it, they all did it. So they all increased the server life, and I think that also has accelerated the PPE. And also partially, not only did it increase the capex side, it also spreads out the depreciation, so the PPE will stay up for longer as it slowly depreciates over a longer period of time. Hopefully that makes sense. A little bit of accounting jargon here. I always like to go through the revenue side as well. Search is just a machine. Google Ads and YouTube ads are just a machine. We knew that Google is under monetized for YouTube, and they're still monetizing it with shorts. I mean, back when we did the video, I don't even think people appreciated shorts, and now it's starting to generate meaningful amounts of revenue. In terms of the monetization metrics, you're always just looking for growth in paid clicks and cost per click. So getting more people to click and making it cheaper, like better ROIs for the advertisers on the platform, which AI will do. One of the things you're going to notice when we go through and through my positions is AI. So most people know NVIDIA is winning. So that's the maker, all right? Like the almost ground zero. But there's going to be other things, and I think AI matching, whether it's ad personalized matching or matching eyeballs, say like a Pinterest thing, or matching dispatcher, like a dispatcher model like Airbnb or Uber. I think these things all improve dramatically with AI. So I think the business models are all going to improve at a faster rate with AI as it accelerates everything. So I think that's the obvious derivative. I'm going to basically just call it matching. AI matching. Any business model that tries to match people, whether it was with ads or with houses or with cars, is going to do way better in the next 5 to 10 years. Honestly, it's probably going to be better in the next 1 to 2 years, given how much they're spending on this. In terms of the call, I just like to look at certain things. Sorry, my train of thought there, but you can see the revenue going up 15 or 60% constant currency, with cloud up 35, and for context, your COGS is only up 10. So you're seeing scale on the main line item, then you're seeing scale across all the other ones. Like R&D is only up 11, with revenue up 15. G&A's declined by 10 partially because of legal, right? But revenue's up 15. Revenue's up 15, but sales and marketing only increased by 5. So you're just seeing scale across every single line item on the P&L, which is exciting. Like there's no miss here for me. And honestly, the business model here is the best. The biggest risk is antitrust, right? Because they're just so big, so powerful. And it shows up like a sore thumb when we go through like the last 10 years of Google. It's just been insane. This is the capex talk. Really here, the line here. We think we're going to see an increase in 2025 in capex spend. And we'll provide more color on the Q4 call. But it won't not be the same percent step up that we saw between 23 and 24. But still an increase. So it's going to be up more than 24, but it won't be the same level that it shot up between 23 and 24. So that's rate of change positive in terms of capex spend when we're doing that to 24. So that's exciting to me, because that's just another benefit that wasn't here in 24 for Google. What else is there? I mean, we talked about the cloud growth already. I'm trying to keep these short. I just love looking at the growth of the company. Just imagine going from 55 billion in revenue to 307 billion in revenue in a decade. That's amazing. And you just see like the EPS churn out, the margins just improve from 16 billion in operating income to 84 billion in operating income. Just amazing scale and numbers. And then we're finally seeing the buyback show up. So, which will only accelerate things. Now, ultimately, hopefully Google stays relatively cheaper. It's not dumb cheap. It's not like buying more, right, when you're up 62%. But I do try to find pullbacks in it, especially if it's just headline noise or something, right? But in terms of the business model, based on current information, it's just perfect. It's a really beautiful company. It scales so well. Visa's just something I don't know. I missed that train. It's done very well. Um, should have been one when I was looking at inflation riders. Remember when we're doing like KEG and other things that ride on inflation, like technically Airbnb and other things that basically ride on a take rate. It should have been one on my radar. So in hindsight, I have this down to like look at it more. But the reason why I look at it every quarter is because I just like to see the macro context and color that they provide and seeing where things are coming in at. So you're seeing growth across the board, far outpacing inflation. So they're just people are still spending on their credit and debit cards, and it's only going up. And they do have a superior moat, obviously. They've pretty much locked up the whole world. Visa, MasterCard. The world runs on credit. But anyway, there's no signs of slowing down. We did see technically a slowdown in cross-border during this whole August, September, and we've seen kind of a recovery in October, and we've seen it in also domestically as well. So we've kind of seen a little bit of a rebound. I think that's why stocks have done a little bit better in October than normal. Usually October is not a great month, but it's been very good. So anyway, just sharing that little context. Again, what I like to look at is nominal growth versus constant growth in terms of US dollars. And then their guidance. So this was actually this is their Q4 quarter that they just reported. And I like to see their guidance. And their guidance is basically really strong. So they're basically saying no slowdown in the world for 25. That's what this guidance would tell me when you're guiding to low double-digit EPS growth, low double-digit revenue. It's just and the scale obviously of Visa is huge. But yeah, they're not seeing a slowdown yet, which is interesting because certain companies are saying like the little guy like companies like think Dollar General is hitting 52-week lows, or Dollar Tree, which we also own, hitting 52-week lows that we're trying to add into. They're all saying like the low end consumers not showing up anymore. They're making hard choices, and Visa's saying there are no hard choices. Everyone's fine. So it's interesting to see how certain companies that scale or skew to certain demographics in certain regions in the world or in America are feeling it at different times. So anyway, I just thought those worth bringing up. In terms of macro, what I do is I just go Control F macro on the transcript, and I just try to see like what's going on. And again, they still say growth was less than 1% year over year in APAC, and most of it due to mainland China. So China's been weak for a long time, and the growth there has been slowing. I think usually what happens in a macro recession, which I think China's been in, is credit's the last thing to basically churn. So it's like everything else, and then credit reacts at the end. Like the credit contraction is usually near the end of the cycle. So we'll see if that's true this time. I mean, I'm excited. It's hard to, in terms of rate of change, it's hard to do worse than growing 1% year over year, especially after 4 years of stock market declines in China, right? And we saw a recent recovery for a bit there. And we're along a couple China names that we'll hopefully get into, Mininso and Yum China and a couple other ones. But these companies are dirt cheap, right, relative to American companies, or relative, honestly, to Canadian companies, relative to almost every other company, maybe like Brazil and Turkey. they're around that level of cheapness. So we'll see. We'll see what happens. I think part of it needs to be a policy change in China, but I think they are coming along with that term. But it's interesting to see how relatively inept the policies have been to getting stimulus and people spending in China. Because we know the saving rate has always been relatively high, so it's just like people don't want to spend, which is an interesting problem. And again, this was just I was trying to figure out why they made their 2025 guidance to be so strong, and they're basically just assuming whatever Q4 ended at, which was relatively strong. They basically said they're going to do the same for the rest of 2025. That's what they're currently doing. And thinking there is that they're not seeing any weakness yet that would make them need to call out anything specifically aside from what they called out with China, which had the weaker growth of 1% year over year. So anyway, that's just some Visa thoughts. I figured I'd add that in even though I don't own it. It's definitely one that I always follow just to see what they're seeing, right? Does that make sense? Like, we know China's equities are weaker. I am surprised how well it's all held up given what we've seen at color of some smaller companies. But I mean, Visa's just a beast, right? And it sees everything, so that's why I like to listen to the call and I read it really quickly just to see if I can see anything that could help me. And usually it's for opportunities, right? So I'm like, okay, I know China's not over earning right now because no one's spending any money on credit cards. So I know that whenever that credit card cycle starts to churn up again, it's going to be exciting. So that's just something that I look for, and I figured it's worth bringing up to you guys. But yeah, anyway, that's it for today. Like I said, I got IMAX tonight. I think we got Meta and Roku. And then tomorrow we got Uber. So quite a few names. Always exciting. I love earnings season. Lots of information to go through. Anyway, I hope you guys liked the video. I'm still upstairs in the spare room for today and the rest of this week anyway. Probably will get back downstairs Sunday or Monday, back into the grind, my normal office. But yeah, take care, guys, and have a great day.